Intro. What if you could bend a country's entire stock market to your will? Not with an army of traders on a chaotic floor, but with a few lines of code and a handful of algorithms moving faster than a human can blink. This isn't science fiction. One of the world's most secretive and powerful trading firms, Jane Street, stands accused of doing just that in India. Regulators say the firm devised a sophisticated, predatory strategy designed to systematically fleece the market, raking in hundreds of millions of dollars in illegal profits. This is the story of the two-patch scheme, a scandal that has peeled back the curtain on the dark side of high-frequency trading. It has ignited a firestorm between a Wall Street giant and a powerful regulator, and it all blew up in the most public way imaginable. Section 1. The Secret World of Jane Street. So, who is Jane Street? Well, this isn't your typical Wall Street firm. Founded by a small group of traders and tech wizards, Jane Street is a fortress of secrecy. They're a proprietary trading firm, meaning they trade with their own money. Think of it like a professional poker player betting their own massive bankroll, rather than a casino that takes bets from customers. They operate in a world of complex mathematics, hiring PhDs in physics and math to build algorithms that can spot and exploit tiny, fleeting inefficiencies in global markets. They are pioneers of high-frequency trading, or HFT. Imagine trying to catch a single drop of rain in a hurricane. That's the world HFT lives in. It's a system that can make millions of trades in a single day, often holding a stock for just fractions of a second. HFT firms use powerful computers and lightning-fast data connections to execute orders at unimaginable speeds. They often act as market makers, which is like being the airport's currency exchange booth. They always have both dollars and euros on hand, allowing travelers to trade easily, and they make a tiny sliver of profit on each transaction, ensuring the market keeps flowing. And Jane Street is a master of this game. It's a global behemoth, trading in 45 countries and pulling in billions in revenue. But their quiet dominance was shattered on July 3, 2025, when the Securities and Exchange Board of India, or SEBI, dropped a bombshell 105-page order accusing Jane Street of a massive, calculated market manipulation scheme. Section 2. The Indian battlefield, the Bank Nifty. The stage for this alleged crime was India's booming derivatives market, specifically the Bank Nifty index. The Bank Nifty tracks the 12 largest and most liquid banking stocks in India. Think of a derivative as a bet on the weather, not buying the rain itself. And the Bank Nifty is like the weather forecast for India's biggest banks. It's famous for its volatility, making it a playground for traders looking to score big profits from price swings. It has also seen a huge influx of retail traders, everyday people trying their hand at the market, often with limited knowledge. This mix of volatility, huge volume, and a high number of less sophisticated traders made the Bank Nifty the perfect hunting ground for a predator with the speed and scale of Jane Street. And according to Indian regulators, on specific days, the weekly expiry days for options contracts, Jane Street unleashed its powerful algorithmic weapon. Section 3. The two-patch playbook unveiled. SEBI's investigation uncovered a stunningly consistent pattern, a playbook they dubbed the two-patch strategy. Jane Street allegedly repeated this on at least 18 different occasions between January 2023 and March 2025. Patch Y, the morning pump. The day would start with a calculated assault. Between 9:15 a.m. and about 11:46 a.m., Jane Street's algorithms would begin aggressively buying up stocks in the Bank Nifty index. It was like using a giant industrial fan to push a single feather higher and higher, creating the illusion that it was flying on its own. On some days, their activity accounted for 15 to 25% of the total market volume in major bank stocks. For example, on January 17, 2024, the firm allegedly flooded the market, buying over 4,300 crore rupees, about $550 million, worth of Bank Nifty stocks and futures. This massive buying pressure did exactly what you'd expect. It artificially inflated stock prices. To the average trader, it looked like a strong, bullish morning. But while this was happening in the open, Jane Street was making a secret, colossal bet in the shadows. At the same time, the firm was building a massive bearish position in the options market. They bought huge quantities of put options, which are like taking out an insurance policy that pays out if the market crashes. On that same January day, they built a bearish options position with a cash equivalent value of over 32,000 crore rupees. Think about that. It's like flooring the accelerator of a car to make everyone think it's fast, while secretly placing a multi-billion-dollar bet that the engine will explode in the next 60 seconds. Patch 2, the afternoon dump. Then came the second patch. In the afternoon, after setting their trap, the algorithm would flip the switch. Jane Street began aggressively selling everything it had bought. They turned off the giant fan, and the feather plunged. On January 17th, they sold over 5,300 crore rupees worth of assets. This sudden flood of sell orders created immense downward pressure, causing the index to fall sharply, right as the options contracts, their insurance policies, were about to expire. The profit machine. According to regulators, this two-step process was a masterclass in manipulation. Jane Street would intentionally take a small loss on its stock trading, but those losses were just the cost of admission to a game they had rigged. The real prize was in the options market. The artificial fall in the index, which they themselves had engineered, caused the value of their massive bearish options positions to skyrocket. On January 17, 2024 alone, SEBI calculated that Jane Street lost about $7.5 million in the stock market. But it made a staggering $89 million in options profits. Across the entire period SEBI examined, the firm's options profits topped 43,000 crore rupees, or over $5 billion. Section 4. The smoking gun, how they got caught. Detecting this was incredibly difficult. Jane Street's trading was spread across multiple stocks and 4 different legal entities. It was like trying to solve a puzzle where the pieces are scattered across different rooms. It was only when SEBI's data scientists analyzed 2.5 years of trading logs that the recurring pattern jumped out. A key piece of evidence was the glaring imbalance in their positions. A normal trader might hedge their bets. It's like carrying both an umbrella and sunscreen. You're prepared for rain or shine. But SEBI found a 7.3-to-1 ratio of options exposure compared to their stock exposure. This wasn't hedging. This was like showing up with a travel-sized sunscreen and a shipping container full of umbrellas. You aren't just preparing for a storm, you are betting everything on a monsoon you plan to create. But the most damning part? Jane Street had apparently been warned. In February 2025, the National Stock Exchange sent a caution letter, advising the firm to stop these trading patterns. According to SEBI, Jane Street ignored the warning and continued the activity into May 2025. Section 5. The defense and the crackdown. Jane Street has vehemently denied the allegations, calling SEBI's order fundamentally mistaken. Their defense boils down to a core concept of modern markets: index arbitrage. Imagine a can of soda costs $1 in store A but $1.05 in store B right next door. Arbitrage is simply buying all the cheap sodas in store A and instantly selling them for a profit in store B, which has the side effect of balancing out the prices. Jane Street argues they were just doing a high-tech version of this, responding to massive demand from retail investors and providing liquidity. SEBI was unconvinced, On July 3, 2025, it issued its landmark order. It banned Jane Street from the Indian securities market and, in an unprecedented move, ordered the firm to deposit all of its alleged unlawful gains, a staggering 4,143 crore rupees, or about $565 million, into an escrow account. The ban was later lifted after Jane Street deposited the full amount, but the firm must cease and desist from using these trading patterns. The legal battle is far from over. Jane Street has appealed the order, and the case now sits before India's Securities Appellate Tribunal. Section 6. The aftermath and the big question. The fallout from this case is rattling the world of high-frequency trading. It signals a dramatic shift. SEBI has drawn a line in the sand, declaring that scale and pattern matter. Dominating 25% of a market's volume and repeating a profitable pattern that harms other investors is no longer acceptable, no matter how complex the justification. This case has also put a harsh spotlight on the vulnerability of retail investors. A 2024 SEBI study revealed that over 90% of individual traders in India's derivatives market lose money. For them, competing against these algorithms is like an amateur chess player sitting down to play a supercomputer that can calculate 1 million moves per second. This scandal forces us to ask a fundamental question. In a world of trading at the speed of light, where is the line between a legitimate strategy and illegal manipulation? When does a sophisticated arbitrage trade cross over into a predatory scheme designed to engineer profits at everyone else's expense? The Jane Street saga is a critical turning point for modern financial markets. Regulators in India and around the world are now grappling with how to police a marketplace that operates at a speed and complexity beyond human comprehension. The outcome of this case will set a precedent for years to come, defining the rules of the road for the age of the algorithm. As this legal battle unfolds, it will test the very definition of fairness and integrity in the 21st century market. What do you think? Was this a brilliant, legitimate arbitrage strategy or a calculated manipulation of the market? Let us know your thoughts in the comments below. And if you want more deep dives into the hidden corners of the financial world, make sure to subscribe and hit that notification bell.